Of the 5 members of the Monetary Policy Committee voting in favor of a 100 basis point hike. Well, we seem to have just narrowly missed that. We're joined now by Bureau for Economic Research Deputy Director George Kershoff. George, good evening to you. Thanks for your time. So we're now back at pre-pandemic interest rate levels. What does that mean, I think, in a very real way for the experience that ordinary consumers will then have?
Yeah, obviously those of us that have home mortgages, also vehicle financing, that means a higher monthly installment payment. And that comes on top of other cost increases. I think the biggest you may have mentioned already was the petrol price increase, food prices. So budgets, household budgets are already tight, and it is becoming more the case. I think people that took on store credit or other loans, unsecured loans, they pay a fixed rate, so they are not affected. And so it is more the higher income groups that have variable interest rates that are now affected by this.
The general consensus, George, seems to be that while the Reserve Bank did not have any choice following on what we saw the US Federal Reserve and the UK Bank do.
That's absolutely right. I think earlier this month, Deputy or one of the governors of the Reserve Bank, Rashad Kassim, he also mentioned the level of the interest rate. Not only do you have to think about increases and inflation in South Africa, but you also have to think about what is the correct level. And international investors, obviously, they take this level into account when they decide, do we invest safely in Europe somewhere, or do South Africa, with its higher risks, attract our funds, and therefore that is important. Yes, you are absolutely spot on when you say our Reserve Bank had very little room for maneuver, in the sense that if international rates increase, then we have to follow. Otherwise, capital will flow out of the country to those destinations that offer better returns, risk-adjusted returns.
Of course, those banks are also trying to manage their own inflation levels domestically. What does that mean for us going forward? And it really is a question about what can we expect to happen in the next coming months?
Yeah, I think South Africa are performing much better in this respect than the countries, the advanced economies, so the US and Europe specifically. We are used to the supply shock, so high increase in oil prices or a weakening of the currency. And our central bank, the Reserve Bank, responded relatively quickly to that. But also, in contrast to, for example, the US, we don't have demand so strong that it fully overshadows supply. So after the reopening of the economy, after the lockdown, yes, demand improved, but it wasn't as spectacular as in the US, where that huge upsurge, people went out on shopping sprees, and then when they finished with that, they moved into services, and so you had this absolute demand far exceeds supply, and that pushed up prices and then spilled into wage increases, because in contrast to South Africa, there they have a shortage of workers, and workers were in a good position to demand higher wages. So from that perspective, South Africa is performing better. And it will take a while. The Federal Reserve mentioned, interest rates could go up a further 75 to 1 percentage point in the US. And that means for us also, we will follow that. But so interest is one thing, but I think one must also remember that with that, hopefully inflation is coming down. I think one must also make clear that lower inflation doesn't mean that prices decline. It becomes cheaper. It just means it is not increasing as fast as previously.
All right.
So, yes.
George Kershoff, we'll leave it there then for tonight. Bureau for Economic Research Deputy Director. Let me thank you for your time.